just sharing the recordings with you guys who are not able to join the session. Okay. Just a second more. This last WhatsApp group people are connecting themselves to join. Okay, we have them here. Okay. So I'll just share my screen as well. So for all of those for whom it's a first session, so my name is Maurya Hanspal, and I'm the founder of Motivational Monetary Fund Hours, which aims to guide people into the financial education and ultimately achieve that goal of financial freedom. And apart from that, I'm working at JP Morgan Chase and Company as a senior financial analyst. And for all of those for whom it's not a first session, so welcome back. So before I share my screen, I'll just give you a view of what all we did in the previous sessions for ratio analysis. So the previous sessions on the sessions for ratio analysis, apart from those modules, we talked about the liquidity ratios. And there we talked about the current ratio, the quick ratio, right? The cash ratio and the working capital ratios. And we also talked about the capital structure ratios. In the capital structure ratios, we talked about the debt to equity ratios. We talked about the debt to EBITDA ratios. We also talked about the return on asset ratio or the turnover asset ratios, right? And we also talked about the valuation ratios, the EPS, the price to earning ratios, the price to book ratio. So all these sessions have been covered in the past, and the modules and also the recordings of the live lectures have been uploaded on the website. Okay. So from all those ratios, a few of my students had some queries, right? So I'll be just solving those queries from a different perspective, from the perspective of a financial analyst or the perspective of an investment banker or the perspective of an equity research analyst or an investment specialist. Okay. And these questions are also asked in your corporate interviews when you tend to appear for such a role. Okay. So before starting with the discussion, I'll just share my screen, my whiteboard, so that I can just write down those ratios and can explain the doubts which my students had. So just give me a second. I'll just share my white screen. Just let me know if my screen is visible to all. Yes, 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 yes. Okay, okay, okay. Fine, fine. Okay. If any of the queries you face in between, like regarding my sound or regarding my camera or sharing my whiteboard, just do like let me know. There can always be some connectivity issues. Okay. So the thing is, the ratio for which the student had the query from a different perspective was the first ratio was he talked about the current ratio, quick ratio, and your cash ratio. Okay. He asked me that out of these ratios, which ratio is the most important one? Or when we're going to analyze the company from A to Z, which ratio we must focus upon to the best? So all these three ratios are important, but his question is quite valid. And the same question is asked in your corporate interviews as well. When you tend to go for the jobs of an equity research analyst or investment advisory jobs. Okay, so for all these things, this question is very common. They tend to say you that you have key ratios in liquidity metrics, the current ratio, the quick ratio, and the cash ratio. So which ratio is the most important one? So first of all, we should know the formulas of these ratios, which I've told in the modules and the previous live sessions as well. The current ratio is simply your current assets by current liabilities. Your quick ratio is your current assets. Just the only difference is in the numerator, you tend to subtract your inventories and prepaid expenses. Rest all is same. Divided by your current liabilities. And in the quick and in the cash ratio, you have your cash plus your market equivalents or your marketable securities divided by your current liabilities. So first of all, one thing we should know is the denominator of all these ratios is same. You have the current liabilities. In the current ratio, in the numerator part, you have all the current assets. You people can keep on like writing down your queries in the chat box. I'll handle the same. Right, Umesh? Okay. So in the numerator, we have the current assets. In your quick ratio, you have those current assets in the numerator. but you subtract your inventories and prepaid expenses. Or simply you can add your current assets excluding your inventories and prepaid expenses. And why are we not taking into consideration your inventories and prepaid expenses? Again, this is a question which is asked in your interviews also. That why in the quick ratio, we do not take into consideration your inventories and prepaid expenses. The reason is because the businesses tend to assume that your inventories and prepaid expenses are the least liquid assets, means they cannot be converted into cash easily. Liquidity simply means the ability of an asset to get converted into cash. So when we are talking about the current assets, you have your inventories, you have those prepaid expenses, you have debtors, you have cash equivalents, correct? And apart from that, you tend to have some other short-term current assets, some short-term loans and all that stuff. So out of all those current assets, inventories and the prepaid expenses are the least liquid. Why? Like for example, if your business has some inventories, it is not mandatory or it is not compulsory that if my business is having 100 stocks, all my 100 stocks would be sold. It can happen that the demand for some of the goods gets outdated, or the weather conditions changes, or some kind of change in the fashion or change in the taste of the consumer takes into place. And because of that, the existing inventories which I have in general are not able to get sold off. And that is the reason we tend to say not all the kind of inventories or goods can be sold off always in a business. If they are getting sold off, it is best. But if they are not getting sold off, it is bad. Correct? And for the prepaid expenses, your prepaid expenses are something for which you have already paid off and the benefit of which you have to take. So, for example, if a creditor comes to your business and says you that he wants certain money, you cannot use that prepaid expenses. Why? Because you've already paid it somewhere and you have to utilize that money. So that money has gone, right? Same in terms of inventories. For example, if an urgent creditor comes into place and wants some money, it is not mandatory that you might find an adequate buyer at that particular point of time to sell off your inventory. It can happen, it takes for you days and months to sell off that component of inventory so that you can get the money. But that urgent requirement of that particular lender or the creditor might not be fulfilled. So that is the reason in terms of all the current assets, these comes to the last in terms of liquidity. So that's your answer for this question. Okay. Huh. So coming back to cash ratio. So in the cash ratio, you have just the cash and cash equivalents or the marketable securities in the numerator and the current liabilities in the denominator. But all this you don't have to explain when they ask you that which ratio is important. You have to start from this point, from the point I'm starting right now. Say to that person, sir, ma'am, or like whatsoever the name is, in current ratio, we are taking into consideration all the current assets, which might not get liquidated immediately. I'm going slow and I'm repeating the answer to that question. If the panelist asks you that which ratio is the most important one among the current ratio, quick ratio, and the cash ratio. So the answer to this question basically is in your current ratio, in the numerator part, we're taking into consideration all the current assets, your inventories, your prepaid expenses, it can be your debtors, it can be your short-term loans or advances, cash and cash equivalents. Not all those current assets might be able to get converted into cash easily or might not be so much liquid to get converted into cash easily because for inventories, we might not find a buyer so that he can buy our goods and give us the money. Prepaid expenses we have already paid off, so no use of that money. Debtors are those persons or account receivables are those people from whom we have to recover the money. We cannot force those people to pay us back the money before the stipulated time. Like, for example, we might have sold someone to XYZ. Okay, like, for example, I'll take just like one random name from the call. We have Anita on the call. Okay. So just assume that if Anita is my customer, I sold some goods to Anita and that was a credit sale. Matlab, she won't give me the money right now. So as per my business policies, I told her that you can pay me the money after 2 weeks. Okay. If some urgent lender comes into place and that person says me, मुझको तो अपना पैसा भी चाहिए, right? So I cannot force Anita to pay me the money before 2 weeks. Why? Because that will hamper my customer relationship and business policies, right? So ultimately that money is blocked. So from debtor also, I cannot recover that money. Correct. So prepaid expenses is gone, inventories is gone, and debtors is gone. Correct. Your short-term loans and advances. Again, you cannot force that person to pay you back the money, be it a short loan as well. Correct. So in this regards, your current ratio and the quick ratio goes off. And the cash ratio becomes the most important one. Why? Because here you have the cash. Cash is not locked in. Cash is most liquid. Either you have it in your pocket in your purse or you have that cash in your bank account. You can pay via Paytm, Google Pay, GPay, Phone Pay, XYZ. But that money is there with you. You do not have to sell some assets, some current assets, some short-term investments to get back that money. So cash is something which is there with you at present, and you can liquidate that. You can pay off that money to that lender or the creditor from whom you might have taken loan in the past, if that is an urgent requirement or an urgent need for business. Correct? So that is cash, and that is the reason your cash ratio is the most important one. One hidden fact I will tell you. In this ratio, I mentioned cash and marketable securities or your cash and cash equivalents. So this you don't have to tell to the person or the panelist. Okay, this I'm telling you in general. Like what happens when the people who are doing the jobs of equity research at big companies like Motilal Oswal, at DSP, at JP Morgan, at Goldman, at Morgan Stanley, at Citibank, when they take into consideration that cash ratio, they're taking into consideration cash plus cash and cash equivalents, correct? But my thinking is somewhat different, and I'll share that thinking to you, correct? Because ultimately, when you are valuing a company or creating the financial model of the company, that is based on your assumptions might not match to an equity research analyst of a top tier company. You might be right, he might be right, but different assumptions give different values. करेक्ट सो माय मानना मेरा जो मानना है वो ये है कि इन द कैश रेशियो नेवर टेक द कैश एंड कैश इक्विवेलेंट्स ऑलवेज टेक कैश मतलब डोंट टेक योर मार्केटेबल सिक्योरिटीज और शॉर्ट टर्म इन्वेस्टमेंट्स इन द न्यूमरेटर पार्ट ये पार्ट हटा दो जस्ट टेक कैश बाय करंट लायबिलिटीज व्हाई because when you are taking into consideration your short term investments and marketable securities, so first of all we need to understand that those are those instruments. Your short-term investments are those instruments which you are planning to sell in less than 1 year. ठीक है? ये कोई long-term investment नहीं है. Correct? So it can happen when you are selling your short-term securities, be it short-term bonds or short-term equity shares. It can happen that you want to sell them on a weekend, be it Saturdays or Sundays. It can happen that you want to sell them on a gazetted holiday, Independence Day, Republic Day, or Gandhi Jayanti. The markets are closed that time. But asset management company or the exchange might not be able to process that amount and give you that amount into your bank accounts immediately or in T plus one, T plus 2 days, like whatever it is. Okay. And you might require that money on a gazetted holiday, or you might require that money on a weekend. And on that day, the AMCs are closed, the market is closed, the broker is on a leave, like he's sleeping somewhere. Correct. So he might not be able to process your requirement, but the lender is on the top of your head. तो बोल रहा है मुझे पैसा चाहिए 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 अगर नहीं दोगे मैं केस कर दूंगा आज करेक्ट सो इन दैट केस that might not be a fully liquidable component though it is highly liquid but as compared to cash it might not. So what do I do when I am valuing a company? I do not take into consideration cash equivalents. I just take into consideration only cash while preparing the financial model of that company, and that is something different which I am doing as compared to the research analyst. Like some person might be doing it or not, but in most of the financial models of the top corporate, which I have seen, they've taken into consideration both cash and cash equivalents. I'm not saying that is wrong. It's a very correct measure, but that's my kind of an ideology or an assumption, you might say. Correct. So that is something, your answer to that query, that first question. So just tell me in the chat box, do you guys agree to my explanation about all these things which I told you? If not, tell me why on the chat box. I'll be happy to explain. Because you people can have your own assumptions. You people can have your own thoughts. Because when we prepare a financial model, different people have different thoughts, and that is completely acceptable. You are not wrong and I'm not wrong. Everyone is correct. But having no assumption is wrong. If you guys have no assumptions, have no thoughts upon the financial model, that is wrong. Correct? But if you people have your own assumptions, that might be wrong in my eyes, it might be wrong in some other eyes. But it is very much fine, glad, it is wonderful in the eyes of the finance gurus that you people have your own thoughts and own ideologies, which might not stand true into my eyes, right? Or some other's eyes. But having something is the best thing that you can have. Okay. Just tell me, do you agree with my points to this point of time? If not, it is fine. Then tell me why. Okay. So that's completely fine with me. Cool, chill. Okay. So Raghav says, yes, he agrees with my point. Anita, Umesh, Rahul, Sen Gupta, Vishali, thank you, thank you. Akshita, fine. Nidhi, fine. Nishika, fine. Thanks, 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 thanks. Like there are some names. I won't be able to take a lot of names, but thank you guys. If still any queries, just like let me know in the chat box. Okay. The second query which people asked me, and I would request Himesh to please allow the people from the different WhatsApp groups who are still joining. Okay. Thanks, Himesh. Okay. So one was about your debt to equity ratio. Okay. So again, the ratio is too simple to understand. We know that debt is in the numerator and equity is in the denominator. Now, again, we know what the ratio should be as low as possible, like close to zero. Why? Because ultimately we want the equity should be more and debt should be less, and that shows that the business is strong, right? कि business पर कर्जा कम है, business पर debt कम है, and the bankruptcy cost of the firm is low. Correct. So like that is the thing. The first doubt which I had was when we are taking into consideration debt in the numerator, should we take only the long-term debt, only the short-term debt, or both long-term debt and short-term debt? Correct. Sirf short-term debt lena is completely wrong. Okay. The confusion that people have to take just the long-term debt or both the long-term debt and short-term debt. In your books, like when you pursue your BCom, BBA, BMS, MBA, and like all that stuff, the faculties tend to say, take into consideration only the long-term liabilities. That's a bookish knowledge. Okay. Taking into consideration the long-term liabilities is something which is not completely correct. When you're analyzing the companies in detail, okay, when you are analyzing the companies in detail, the thing is you have to take into consideration both the short-term debt as well as the long-term debt. Okay, both the short-term debt as well as the long-term. So if this question is asked in your interviews, take into consideration both the long-term debt and the short-term debt. Correct? So that is your first answer. Now people ask me, if the debt to equity ratio of a company is higher, अगर किसी कंपनी का debt to equity ratio is higher, is it always bad? मतलब, when will the company have a higher debt to equity ratio? The company will have a higher debt to equity ratio when the equity is less and debt is more. So that is a risky signal, correct? But it is not always bad. Why? The interviewer will ask you a question. He will say you, is having a higher debt to equity ratio always bad? Matlab, if the firm has higher debt, is it always bad? No, it's not always bad. Why? See, there are two things. Okay. The first thing is, if the debt is being used for the productive purposes, if the debt is being used for the productive purposes, अब सबके दिमाग में एक स्टॉक आएगा, अदानी, कि वो भी तो डेट प्रोडक्टिव पर्पसेस के लिए यूज कर रहा है. सिर्फ एक फैक्टर को नहीं देखना, there are multiple factors. You have to take into consideration all the factors. Be patient. Give me a second. I'm telling you. First factor is, and यहाँ पर हम अदानी का भी एग्जांपल हम साइड बाय साइड समझते रहेंगे, ठीक है, बिकॉज दैट द लेटेस्ट सिनेरियो. If the debt is being used for the productive purposes, and on account of that, the debt to equity ratio is high. What do I mean by the term productive? If a business is using it for further expansions, further diversifications, further manufacturing, and that can give good results to the firm, not currently, but maybe after 5, 6, 7, 8, 10 years. And so that's a good debt, a productive debt. And that is not only for expansion and diversification. Further in diversification and expansion, you must look what is the current business of the firm, right? For example, agar, if you talk about an IT company, if you talk about Infosys, okay, it is into IT or like cloud computing and digital world and all. If that company is investing into IT technologies, advanced digital themes, it's a good productive expansion. But but if Infosys is expanding into building commercial real estates, building a metal factory, manufacturing biscuits, that is expansion and diversification, but not productive for Infosys. Because Infosys is an IT business. Over the years, it has done IT business. People know it for IT. It has captured the hearts and minds of people in terms of IT. People trust that company in form of IT, but not for FMCG, metal or commercial goods. There is always so much saturation and competition among the metal industries and companies which are already on top, right? So that company cannot go into that theme. Provided if IT had been a conglomerate, if Infosys had been a conglomerate from very beginning, कि मान लो कि automobiles में भी होता, IT में तो है ही, FMCG में भी होता, and metals में भी होता, and if that company is going for some good expansion, किसी और field में जा रहा है, मान लो कि सीमेंट्स में जा रहा है, so hypothetically the company is already a capital intensive company. It's a heavy good industry. तो अगर सीमेंट में भी जाएगा, it's fine. Same example as Adani. Adani was always a conglomerate. It was into multiple businesses. And then it did some kind of acquisitions into cements, into NTTV, into chemicals, and all that stuff. So for that case, we can say Adani, since it was already a conglomerate, it can expand into different things, either by brownfield expansion or greenfield expansion. Brownfield expansion is already it is doing some acquisitions of existing business to make its business strong. ठीक है, कुछ नया नहीं कर रहा. ग्रीनफील्ड एक्सपेंशन इज मान लो कि सीमेंट बिजनेस खड़ा करना है, ठीक है, या मान लो that Adani acquired like some part of NDTV, ठीक है. So like if I take the example of NDTV, it was a brownfield expansion. It was trying to acquire NDTV through shares. And greenfield expansion क्या होता? Adani अपनी खुद की कंपनी लाता, Adani TV 18, Adani का like कोई भी चैनल, ठीक है, like online media. So that was खुद का Adani का होता, so that was a greenfield expansion. Okay. So mostly expansion which Adani has done is a brownfield expansion through acquisitions and all that stuff. So in that case, it is productive. Second case में क्या होता है? Your revenues, your profits, and your cash flows. Okay, revenues, profits, and cash flows. If your debt is rising, the revenues, profits, and cash flows should also rise at least by a same amount to break even or by a greater amount than the debt. We also call it as, I read in a book, beautiful leveraging. I don't know, my screen is hanging. Don't know why. और beautiful deleveraging. मतलब अगर फर्म का डेट कम भी हो रहा है या बढ़ भी रहा है, in any of the scenarios where cash is rising by that more amount, if debt is falling and cash is rising, perfect. That's a beautiful deleveraging. Deleverage मतलब debt कम हो रहा है. And the beautiful leveraging is debt बढ़ रहा है, but your cash equivalents, your profits and revenues are either at par to break even or your cash is rising more than the debt. So that's a beautiful leveraging. कि debt तो बढ़ ही रहा है, but cash उससे ज्यादा बढ़ रहा है. That's not the case with Adani. So that's a red point for Adani. Alarming signal for Adani. A red point. Okay. So in the recent reports, जो भी recent results आए हैं, जो like परसों आए थे Adani Enterprises के, the revenues are rising. So that's a good point. The revenues are rising. ठीक है, but हमें ये भी देखना है expenses कितने से बढ़ रहे हैं. It can happen the revenues are rising by 50%. In the previous year, if the revenues goes by 30%, and this year the revenue goes by 50%, it's good. but you have to see expenses कितने से बढ़े. If expenses came down or were same, then it's fine. But if expenses are also rising by more amount, 50 से revenue बढ़ा, 80 से expenses बढ़ गया, it's bad. And debt भी तो बढ़ रहा है कंपनी का, because interest expense भी तो जा रहा है. In this case, though the revenues rose by 40-50% more than the previous year, but the expenses rose by 60-70% in forms of interest payment. So it's an alarming signal. तो अगर कंपनी की रेवेन्यू बढ़ रही है, ब्लाइंडली मत देखो एंड खुश मत हो. एक्सपेंसेस देखो, अल्टीमेट प्रॉफिट आफ्टर टैक्स एंड इंटरेस्ट देखो, एंड कैश फ्लो देखो, क्योंकि वो नहीं बढ़ रहे. So that's wrong. So that's an alarming signal for the company. Okay, I had a few questions in the chat box regarding Adani also. Opinion on Adani तो दे दिया. जिंदल स्टील पे क्वेश्चन आया है मेरे पास उमेश से. उमेश इज सेइंग these metal companies or basically your capital intensive industries have higher debt to equity ratios and those companies make losses. Yeah, that's completely correct. Like those companies tend to make losses because those people are making their investments for longer term. In this phase, they're making some more investments. So as a result, their capital expenditure or capex would be more and depreciation would be less. In the later point of time, the depreciation would be more and capex would be less. So as a result, their cash equivalents or cash balance can also become positive in future. Free cash flow to a firm, इसका मैंने concept बताया था. So like just revise from the modules. I'll cover this concept in the later sessions also. Okay, so not to worry. Okay. Debt to equity ratio can be explained from the Hindenburg case. Yes, Vivek, like completely agree to your point. Because Adani is having a very high debt to equity ratio. Okay, and that is the problem because they're not able to break even or even have a beautiful leveraging or deleveraging. Okay, and the third and last point for this session, or like debt to equity ratio is, I'll just take a fresh one. So the first one was the productive in nature. The second one was cash revenues and profits to break even or be higher. And the third one that I'm telling you, being very patient, is I've told something about your cost of equity. Just read in the proper way. Cost of equity versus cost of debt. I've explained like what are these. Cost of debt is nothing but the interest payment that you are paying on debt. बैंक से लोन लिया 5 लाख रुपए का, you have to pay like 10% interest rate. That 10% is your cost of debt. Cost of equity. Your cost of equity is nothing but if some people have bought the equity shares of your company. Okay, so that is the minimal average return that you must give to the equity shares of your company. That's cost of equity. Okay, so cost of equity and cost of debt you have to see. If the cost of equity is more than cost of debt, okay, and the firm is taking more debt, the firm is taking more leverage. I'll repeat that point. Till the point of time your cost of equity is more than cost of debt, मतलब the return to shareholders की expectation ज़्यादा है and interest rate तुम कम pay कर रहे हो. Till that point of time when your cost of equity is more than cost of debt and you are taking more debt, it is good for the firm and it will have a magnifying effect upon the EPS of the firm also. What's EPS? It's a profit after tax by your number of outstanding shares, equity shares. So till that point of time, where interest payments are less, means your cost of debt is less than cost of equity, or your cost of equity is more than cost of debt, and the firm is taking more debt. It will always have a magnifying effect upon the EPS of the firm. EPS firm का बढ़ेगा, वो अच्छी बात है. But at ऐसे point of time पे, when the cost of debt becomes almost equal to cost of equity, or cost of debt becomes higher than cost of equity, stop taking more debt. It can be risky for your firm. The EPS of the firm will come down because your interest payments will rise. खर्चा firm का बढ़ जाएगा. Correct? So 3 points in debt to equity when the panelist asks you, is a higher debt to equity ratio always bad? No. It can be good for the firm also. First point, if the firm is taking the productive debt. Second point, if the firm has beautiful leveraging or beautiful deleveraging, matlab the debt is falling, cash revenues profits are rising, or the debt is rising, but the cash revenue profits are rising by a higher amount. And the third ratio, The firm can take more debt, or the firm can afford to have a higher debt to equity ratio till that point of time, where the cost of equity is more than cost of debt. Why? Because till that point of time, the firm will have a magnifying effect upon the EPS, the earnings per share. Got it? Your queries. Tell me your concerns. So if the EPS of the firm is rising, will the P of the firm also rise? Very nice question. मुझसे क्वेश्चन पूछा गया है from Raghavendra Pratap Singh. The person is asking me, and it's a very nice question asked in your corporate interviews also. So thanks for this question. If EPS is rising, will P rise as well? Your P is the price to earning ratio, as told you before. Okay. So when you're talking about your EPS and the price to earning ratio, your price to earning ratio is nothing but your current share price divided by your EPS. Basic maths agar hum padhe. If your EPS is rising, will this P ratio high or low? जब denominator बढ़ेगा, तो obviously the ratio would come down. Correct? Raghav? So if EPS is rising, this P ratio will come down. Correct? And that is a very good signal for the company. It shows the company is undervalued. सस्ती बिक रही है market में. The earnings of the companies are shown by EPS because this includes the profit after tax. The EPS is rising, 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 but the share price is still low or still stagnant. The company might have a huge potential in the future. In that case, you can call this company as an undervalued company and buy that company, taking into consideration other metrics also, liquidity ratios, your debt to equity ratios, and other valuation metrics. Not just on the basis of price to earning, which I have been saying from day one. Don't just focus on one ratio, focus on all the ratios in totality and then make your decision. Correct? Any more queries? Just let me know. So what's your view on Adani? What's my view on Adani? See, like you people tend to put me in very complicated scenarios. Okay, I'm working at an investment bank. I cannot give you stock opinions. Okay, so Shalendra, I will give you a general opinion. If a company is having so much debt, but it's not a beautiful leveraging, a beautiful deleveraging, and the cost of debt is more than cost of equity, which is happening in Adani. Also, there are concerns about your dummy companies or SPVs, like which this company is forming, matlab, uh, like they're having some shell companies, which people tend to blame in like Mauritius and other places where the tax rate is almost zero. They tend to transfer their money into that companies, and that companies are in return putting their monies into like Adani Enterprises. Okay. And recently, the FPOs like also got cancelled, and the money which was there in your existing FPOs was from your foreign institutional investors. मतलब जो बड़े बड़े अमीर लोग हैं. So it is also an allegation that again the people from Mauritius and Switzerland are putting their money into the company back again. जो अदानी की ही shell companies है, मतलब अदानी ने पहले वहाँ transfer करा पैसा and वही पैसा बाद में आया in the form of the FPO. Okay. And also, since it's a conglomerate like your Adani Ports, Greens, Transmission, and Total Gas, the debt of one company can easily be transferred to the debt of the other company, and one company can become clean. Okay, so these things can be done. So if these things are happening, then you can take a call from your side, and you can judge my tone also if I'm positive or negative. But directly, I won't be able to give you or tell you that to buy that stock or sell that stock. But my indirect style of explaining you can tell you like very well. Okay. Any more questions? And we can keep a separate session on like Adani also, like maybe next week. Any more questions? I'm waiting. So what is your view on SRF? I'm telling you, मैं view नहीं बता सकता तुम लोगों को unfortunately, but like SRF Chemical is a strong company. Though the government has increased their subsidies and your further kinds of PLIs for the fertilizer companies. so the fertilizer companies can do well. Okay, they will do well. Particularly मैं stock नहीं बता सकता, but try to research on your side. But the fertilizer companies will do well. Try to see the fundamentals of the companies. Okay. Any more questions? View on budget. Focus upon your capital intensive companies, your capital goods companies, and fertilizers companies, your defense companies. That so that companies can do it. I will keep a separate session on the budget also. Okay. So not to worry. If no further questions regarding this particular sessions, we can just end the session for today. And if any further queries you have, just mention me on the WhatsApp number, on Instagram, on LinkedIn, on Facebook, wherever you find me, or on the WhatsApp. Okay. Okay then. So Akshat says the debt has reduced in past 3 years. Why it has reduced? Because the interest rates were low in the past years, and this company was able to pay more debt. But now, since the interest rates have started to rise, that debt component has